the government has not served the proper role as the rules creator and enforcer, the creator of a level playing field. Instead, it has been an arbitrary rescuer and bailer outer of these financial institutions, and that is not a consistent free market system. That is a system of state capitalism that supports one industry, the too big to fail financial industry, and that is what failed. One of the biggest problems that we face as we supposedly come out of the 2008 financial crisis is that we do not have a system of market discipline for the financial industry. And this is something that we have not had for 25 years. You have an entire sector of the economy that has gradually figured out a way to be immunized from consistent, predictable market losses. And how has it done that? It has done that through making sure that a large or complex financial firm can't fail without taking the rest of the economy down with it. And how do you do that? How do you let a large or complex financial firm go under, go bankrupt, have the lenders take their losses without taking down the rest of the economy? We learned how to do this in the Great Depression. Back in the late 1920s, we had massive speculation, many reasons why you had stock markets bust, banks fail, depression, and so forth. But one thing we learned coming out of that in the early 1930s was you cannot have banks fail in a disorderly fashion. A bank that takes deposits from the public, it can't go out of business to have the small depositors take losses because it causes unacceptable public panic and then unacceptable market and economic consequences. But on the other side, the government, to its great credit, understood that you could not have banks not fail. You had to have a way for markets to discipline banks, otherwise they would be even more reckless than they had been. So what did FDR and Congress come up with? After a few fits and starts, they came up with an elegant solution, the FDIC, which said only small depositors, if your grandma with a few $1,000s in the bank, you are protected, but all of the big bondholders, big sophisticated lenders to the bank will not be protected. So the FDIC would seize the banks, protect only the little people, and the big guys would lose their money. And so that meant you had orderly bank failure, market discipline of banks without taking down the rest of the economy. And this worked very well for 50 years. On the other side of that, the FDR in Congress understood you want this system for banks. On the investment side, that is not what you want. You want unlimited risk and unlimited reward. The only thing is you don't want people and institutions to be able to take so much risk in the stock market, in other investment markets with other people's borrowed money, that they bring down the financial system when those risks don't work out. So what did we get? We got consistent limits on borrowing in the stock market, in other asset markets. So since then, roughly, if you want to buy stocks, great, go ahead, you can lose all your money, but you can only borrow half of the money. So when you lose your money, you don't bankrupt the financial system by having debt that you are unable to repay. It wasn't so much that the regulations were relaxed, although some certainly were. It was more that the financial system evolved in a way to escape these regulations. So the regulations never went away. They just stayed put, and the financial industry moved away from them. Government sometimes didn't notice that this had happened, and other times government said, yeah, this is great, we don't need the old regulations anymore, so let's let these guys go out and invent things that the old regulations don't apply to. And I think the most important break in the 1980s, although there were several important breaks, was the evolution of the commercial banking system that allowed it to start to escape market discipline. So you had this old system where banks failed, lenders took their losses. What did that do? It didn't work perfectly, of course, but it meant that if you were lending money to a bank, you knew that your money was at risk. If you're a global bondholder, you're putting $10 million in a bank, you know you've got to make sure that the bank is not being too reckless with your money, because if it goes bankrupt, you're going to lose some of that money. What happened in the 80s, you had the creation of the first too big to fail bank right here in Chicago. This was a bank called Continental Illinois, 8th largest bank in the country. And in 1984, they began to fail, and the Reagan administration stepped in. You had Paul Volcker, the Fed chairman, the FDIC, and the upper echelons of the executive branch saying, we can't let this bank fail through the normal processes. We're going to protect all of the bondholders to the bank. And why did they do this? Because the bank had been kind of a pioneer in creating a way of doing business that added too much risk to the economy if it were to fail. On the commercial banking side, they didn't hold loans on their books for 30 years. Rather, they purchased securitized loans from another bank. What did this do? It meant that they really weren't sure what was in these loans. The bank that sold them to them had no real incentive to care what was in these loans because they had just sold them off for a fee before that bank had gone bankrupt as well. And it meant that you are introducing the kind of panic that occurs in stock markets into the credit markets. You've got loans, securities made up of loans, but they act like stocks. They're just as vulnerable to stock market panic. And so they said that cannot happen. Instead of dealing with the problem that the banks were escaping market discipline because their failure would create an unacceptable cost to the economy in stopping credit, they dealt with the symptom. They said if the failure is too tough to handle, then we won't let the failure happen. And what did that do? It meant that after that, if you were lending money to a big bank, you knew that your money was not at risk. And that is how you get a debt crisis built up over 25 years. It is a government subsidy of debt to the financial industry. People sort of have this disturbing concept that we're stuck with too big to fail. The only thing that we can do is to manage it better, except that we've got these too big to fail banks like Citigroup, B of A, pick your top X banks and investment firms. And so the only thing we can do is say, okay, well, we're just going to make them manage their risk better, or we'll make them pay a higher tax to the government or something like that. That is not the way to go. We are not stuck with too big to fail. This came about because of certain things that we did for 50 years that worked well, that we stopped doing in the 1980s. And the only thing that we really have to do is go back to doing them. And one thing that Congress is not getting in this regulatory bill that is before the Senate right now is that you can't end too big to fail by decree. You can't just say, okay, no more bailouts. You've got to create the conditions so that the economy can withstand the failure of a financial firm. And how do you do that? You have to go back to consistent limits on borrowing. So government no longer says, this type of investment is risk-free, it's AAA rated, so you barely have to put any capital behind it, and capital is only non-borrowed money. Why do you need that? Because it absorbs losses. If you've got an asset that is paid for with 100% borrowed money, that is no capital, it cannot decline by even a percentage point without bankrupting you. So you've got to have some non-borrowed capital, 10%, pick your percentage. It just has to be consistent. What we've done for 20 years is say things that the government perceives as not risky, no capital down, almost things that the government perceives are risky, you have to have high capital. And so what did the financial industry do? Put all of its money in AAA rated securities. The government told everyone to make the same mistake all at once, and the economy could not withstand that.